A couple weeks ago, there was an article on Fortune.com that featured an interview with billionaire investor Stan Druckenmiller. He was asked during the interview what his thoughts were on the future of the stock market and what investors can expect in the years ahead. Needless to say, Druckenmiller's forecast was pretty concerning. He predicts that over the next 10 years, there's a high probability that the market will be flat, meaning that share prices aren't going to experience much growth. Druckenmiller provided several reasons for this prediction, which included an impending recession, the Fed's aggression with raising interest rates, banks becoming super defensive, and continuing escalation in Ukraine. For those who might not be familiar, Druckenmiller is one of Wall Street's best-performing investors in history. He was the founder of Due Cain Capital, which was a hedge fund he created back in 1981. Between 1986 and 2010, Druckenmiller was able to provide investors with an average annual return of 30%. For comparison, the S&P 500 historically provides investors an average annual return of around 8.5% according to Investopedia. In 2010, Druckenmiller converted his hedge fund into a family office, which is a type of investment company that manages investments for very wealthy families. His investing strategies typically include holding stocks long-term and using leverage to trade futures and currencies. Druckenmiller's definitely not alone in terms of having a negative outlook on the future of the stock market. Other investors including Ray Dalio, Michael Burry, and Carl Icahn also share the opinion that the markets are headed for a season of declines and more volatility. This belief is also being shared by some of the largest financial institutions including Goldman Sachs and Wells Fargo, although opinions do differ on how long and how extreme things will get in terms of declines. But it's not just the ultra-wealthy and the financial institutions that are being pessimistic. According to the Consumer Confidence Index, which measures how optimistic people are in terms of the economy, it's currently lower today than it was during the 2008 financial crisis. Druckenmiller also pointed out that he believes the markets will perform similarly to how they performed between 1966 and 1982. If we look at the S&P 500's performance during this period, we can see that for about 15 years, the markets were basically going nowhere. You can see there were years where it rose considerably, but then there were years where stocks fell considerably too. This obviously wasn't a good period for people who are fans of buying and holding stocks for long periods of time. The conditions during this market required you to consistently sell out of your holdings and then repurchase back whenever the market bottomed in order to make any profits. But it's been proven time and time again that it's impossible to consistently beat the market. You hear stories of people who got lucky and bought a stock right when it bottomed out, which led to a massive profit. Or you'll hear stories of people who actually made a great investment after doing a lot of research and due diligence, like Michael Burry, who famously bet against the housing market and made millions off of it. But what you don't hear are people like Michael Burry correctly making the same investments over and over again. Dr. Burry's made many other predictions besides the housing bubble, which turned out to be incorrect. But the fact is, this is extremely common because people make lots of investments, and if one of them soars, you don't hear about all the times they were wrong, only about the times they were correct. So we have to ask the question, if we are in for another long period of flatlining share prices in the stock market, what would be a good strategy to make money under these conditions? You can try to time the market, but it's really more like gambling your money in these situations since we just talked about you can't consistently time the market. If you buy stocks when you think we've recently hit a low, what makes you think they won't go any lower? If you sell when you think we've hit a high, how do you know if they won't soar even higher after that before falling? And if you're a buy and hold investor like I am, then you're not going to get any benefit from this kind of market. For the investor who's looking to make money in a flat market and doesn't want to worry about regularly buying in and selling out trying to secure profits, the best strategy you can pursue is to be a dividend investor. This involves buying stocks, ETFs, and other publicly traded securities that regularly pay investors a distribution of their profits, typically on a quarterly or sometimes monthly basis. You can then either take the dividend money and spend it on living expenses, or more ideally, if you're not retired, you can choose to reinvest all of your dividends into buying more shares of the same stock so that you'll earn even more dividends the next quarter, or the next month, or whatever frequency it pays. In a flat market environment, this is the only investing strategy that makes sense for the investor who wants to earn money during flat times and doesn't want to constantly buy and sell securities, hoping that they're entering and exiting at the perfect time. It's a more passive form of earning money than being a short-term stock trader, with the exception of checking every now and then to make sure that the stocks you're invested in are staying afloat. But you don't have to constantly check the stock market every single day and worry about share prices. Because what's most important here are dividend payments, not share price performance in the short term. You'll be relaxing through a flat market while all of your growth stock investing friends are sweating and racking up losses in their brokerage accounts. If you've ever doubted the power of dividend investing, then you've probably never seen this graph from Hartford funds. They recently conducted a study on the power of dividend investing, and this really doesn't need an explanation. You can clearly see the huge difference between investing in the S&P 500 with and without accounting for dividends and reinvesting them. A $10,000 investment could either become $795,823 or nearly $5 million depending on if you want to include dividends. It's hard for me to understand why a lot of investors could see a graph like this and then still prefer to gamble on high-risk growth stocks like Coinbase or Fastly, both of which are down astronomically this year. For me personally, I like to target higher yielding dividend stocks. I don't like to invest in companies that only offer a 1% dividend yield. I like stocks and funds that reward their investors generously with higher yields. I do invest in some growth holdings like ticker symbol SCHD, but nearly all of my holdings yield over 5%. Some companies like real estate investment trusts and business development companies are required by law to pay out 90% of their earnings to shareholders. It's not uncommon for these types of companies to offer yields of 5, 7, or even 10% or more during current market conditions. At the same time though, it's important to not just chase stocks offering the highest yields. It's a common mistake that dividend investors, both new and experienced, make. It's really tempting to try to make investments in stocks with outrageously high yields but are usually unsustainable. You might come across a company like Orchid Island Capital, which boasts an insane 18.79% dividend yield and think that it's a good dividend investment. But once you do some more digging, you'll realize the company has a long history of cutting its dividend over the years. Plus, its share price has lost over 86% of its value since their IPO. So you need to make sure that you don't invest in dividend stocks that are too good to be true like this one is. Ultimately, only time will tell if Druckenmiller's prediction is actually going to come true or not. But in periods of flatlining share prices, the best way average investors can earn any profits from this market will be by investing in dividend stocks. It's the best strategy to pursue that's not only very easy, but extremely laid back compared to constantly buying and selling out of positions. Whether you choose to be a dividend growth investor or more of an income investor like myself is completely up to you. But despite what some critics say, dividend investing is a solid investing strategy. And if we are headed for a long period of flatlining share prices, then this is going to be the perfect moment for dividends. Stop trying to pursue growth stocks that are being touted here on YouTube as potentially being 10xers. Even if someone does make a good pick, there's never been anyone who's been able to do so over and over again without having duds in their portfolio. Once you're done chasing all of this hype, then that's when you'll really value dividend or income investing. Some of my favorite dividend stocks would include companies like Dividend Aristocrats, which are companies that have made it 25 years without ever having to cut their dividends. Some examples of some high-yielding dividend stocks would include Realty Income, which has been a solid company that's never reduced their dividends since their IPO back in 1994. Right now it currently offers a dividend yield of a little under 5%, but that's fine by me considering their impressive track record and this stock pays monthly dividends. WP Carey is also another solid option that'll be a dividend aristocrat next year. So just kick back, relax, and enjoy the passive income that you'll receive from dividends. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below and also subscribe to the channel if you want to see more high-yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. Alright, thanks again guys so much for watching, and until next time, take care.